Ever wondered how big companies grow and get better? Or how some investors turn small businesses into huge success stories? Well, that's where something called private equity comes in. But don't worry, I'm not here to throw confusing terms at you. Let's break it down in simple terms. Imagine this. You and a few friends decide to invest in a small pizza restaurant. Right now, it's struggling. The pizza's great, but the business is a mess. Maybe the menu is outdated, the marketing is weak, and the restaurant could use a fresh coat of paint. You and your friends see potential in this place, though. You think, with a little help, this could become the next popular spot in town. So you each chip in some money to buy a share of the restaurant. That's the first part of private equity, investing in a business that isn't listed on the stock market. Now you all get to work. Maybe you revamp the menu, redesign the space, and launch a new marketing campaign to attract more customers. You even work on improving the quality of service. Over time, the restaurant starts to get better, attracting more people, and the business begins to grow. Here's the fun part. As the restaurant grows, its value increases. The business is doing better, and now it's worth more than when you first invested. You and your friends are sitting on a much more valuable business than before. So, after a few years, you decide it's time to sell. You find a buyer who's willing to pay a much higher price for the restaurant than what you originally paid. And guess what? You just made a profit. That's private equity in action. You put money into a business, helped it grow, and then sold it for more. In a nutshell, private equity is all about buying, improving, and selling businesses that aren't on the stock market. It's a way for investors to turn struggling companies into success stories, and in return, they make a profit. It's like taking something old and turning it into gold. So, next time you hear about private equity, you'll know it's not some complicated financial term. It's just smart investing and helping businesses reach their potential. There are many examples of companies that grew exponentially after being acquired by private equity firms. Burger King, Hilton Hotels, Domino's Pizza, and Dollar General are few examples. But how this seemingly good thing have potential to mess with the economy in ways we don't always notice. Let's see how. Imagine buying a house you can't afford by taking out a massive loan. That's pretty much what private equity firms do when they buy companies. They borrow a ton of money, then pass the debt to the company itself. Sounds smart, right? But what if the company is not able to generate that much revenue? If the company can't pay back the loan, it collapses. Workers lose jobs, suppliers lose contracts, and entire industries can feel the shockwaves. All because someone wanted a quick flip. Private equity firms love speed. Their goal? Buy a company, make it profitable as fast as possible, and sell it. But sometimes speed kills. To make quick profits, they cut costs, lay off workers, slash budgets for research, and focus only on what looks good in the short term. The result? A business that might survive a few years but struggles in the long run. When private equity firms take over, they don't just buy businesses, they often extract huge fees and profits for themselves. That's money not reinvested into local jobs or growth. It's like fixing up an old car to sell it quickly, but skipping the important engine repairs. It might look great and run fine for a little while, but sooner or later it breaks down completely. Here's a harsh truth. To maximize profits, private equity firms often cut jobs, outsource, or replace people with machines. And while efficiency sounds good, the reality is families and communities lose stability. It's a ripple effect. Fewer jobs mean less spending in local stores, and soon, the whole town feels it. Private equity has so much money to spend that they often overpay for companies, driving up prices in the process. Think of it like a bidding war for a rare collectible. Overpaying means there's less room for profit. If these inflated valuations can't hold, the bubble bursts, and just like the housing crash in 2008, it can hurt everyone. Private equity firms aren't just buying restaurants or retail stores. They're in our hospitals, housing, even schools. Sounds scary, right? These are industries that directly impact people's lives. And when profit becomes the priority, service quality can take a backseat. Imagine hospital bills going up or rent skyrocketing. Well, there is nothing to imagine because it's already happening. When private equity firms buy up too many businesses in one sector, competition dies. It's like having only one pizza place in town. They can charge whatever they want, and you're stuck paying for it. Without competition, prices go up, innovation slows down, and consumers lose out. Everyone except the private equity firms, of course. Here's the sneaky part: your retirement savings might be tied to private equity. Pension funds and investment portfolios are often big backers. If a private equity investment fails, retirees could lose a chunk of their savings. That's millions of people depending on risky bets for their future. Private equity firms make billions, but the wealth stays at the top, with fund managers and a few investors. This widens the gap between the rich and everyone else, making economic inequality worse. It's like a pie where the richest people take the biggest slice and leave crumbs for everyone else. When private equity-owned companies fail, they don't just hurt themselves, they take others down with them. Think suppliers, contractors, and even local businesses that depended on them. It's a domino effect that makes the whole economy more fragile. And when cracks form, it's everyday people who bear the brunt. Private equity isn't all bad. It can save struggling businesses and drive growth. But as we've seen, it can also cause harm if left unchecked. So, next time you hear about a big buyout or deal, think about the bigger picture. And remember, understanding these systems will help us in having a better view of the financial world. If you enjoyed this video, don't forget to hit that like button and subscribe. Join us to build a stronger understanding of finance and its philosophy, all in a way that's easy to grasp.